Hey everyone, it's Mike Bonn with the Cash Flow Company. Today we're going to go over numbers. How do you calculate a point? How do you calculate simple interest? How do you calculate loan to ARV and loan to value? Things that you need when you're in real estate investing, but sometimes it's just confusing, especially if you're not into the numbers or math, but things you need to know, because how do they impact your cash flow? How do they impact closing costs? All those things. So we're going to go over step by step. So grab a piece of paper, pen, and go through some examples with me so you just understand, how do I calculate that point in that interest? So first of all, let's look at when a lender says, I'm going to charge you a point, 1 point, 2 points. What does that mean? We get this question a lot. So when we're looking at a lender telling us, I'm going to charge you, in this case, let's just look at a lender who's going to say, I'm going to charge you 2 points. How do you calculate? What does that mean? So a point in the lending world is percent. So 2 points equals 2%. So it's 2% of your loan amount and not your purchase price. So when you get a loan, they're going to charge you, in this case, 2%, and that's the origination. That's what you're going to pay your mortgage originator or the lender. So the 2%, how do you calculate that? Let's look at an example. Let's say we have a loan for $150,000. That's your loan amount. Let's put that for a reminder down here. It's your loan amount, and they're going to charge you 2%. So 2% is 0.02. Grab your phone, grab your calculator, whatever it is, and type in $150,000 times 0.02 in this example because it's 2 points. So 2 points at $150,000 loan equals origination fee of $3,000. So that is a fee that you pay for the loan. So that fee is going to be included in your closing costs. When you go and figure out how much you have to bring in for closing, you're going to have your down payment, you're going to have your appraisal and credit, some of those other things, but it's also going to be the point. So this $3,000 fee, which is 2 points or 2% of your loan amount of $150,000, you're going to have to add that in to what you have to bring into the closing. So that's what a point is. It's a percentage of the loan amount. Let's look at next the interest rate and how you calculate what your interest payment is monthly on a simple interest mortgage. So we looked at how do you calculate a point. So how do you calculate your monthly payment? Not only DSCR has some interest only, but all your private money, all your hard money is going to be interest only, simple interest. So when someone talks to you and says, hey, you're going to be charged 11% or 12% on your loan amount, what does that mean monthly? What does it mean coming out of your pocket? We get this question a lot. So let's look at an example here. And let's just stick with the $150,000 that we used in our other example. So a loan for $150,000. And your lender says, hey, interest rate is going to be 11%. And the 11% is annual. Some people get confused that they're going to charge you 11% if you keep it out a month, 2 months, 3 months. But the 11% is actually an annual rate. Now, how do we set this up? How do we use our calculator to figure out exactly what your monthly payment is? First of all, what we're going to do is we're going to take this loan amount of $150,000 and we're going to times it. We're going to times it by the interest. So in this case, multiply it by interest, which is 11% is equal to 0.11. And when we put that in our calculator, what we're going to find is we come up with a number, so 150,000 times 0.11. We get a number that equals $16,500. But that's the annual. That's what they're going to charge you in interest on an annual basis. You're more worried about monthly. So now you have to take this $16,500 and divide it by 12. So the 12 months in a year. And this will give you what you're being charged monthly or what you have to pay monthly. So we have the $16,500 already in our calculator, and we're going to divide that by 12. And what we find is our payments are $1,375. And it's good to run through these numbers. It's good so you understand, once again, it's an annual rate. It's not something they're going to charge you if you have it out for 3 months or 5 months. It's just what they're going to charge you on an annual basis. And remember, just take the loan amount, times it by the point, whatever your interest rate, if this was 12% would be 0.12, whatever that is. That gives you your annual interest, but you have to divide that by 12 to see what it is monthly, and that's what you're going to pay monthly as long as your loan is outstanding. We looked at point, we looked at interest rate, our monthly interest rate and simple interest. Now let's look at another thing you need to calculate, which is loan to ARV. ARV is after repair value. So that's what you estimate the value to be based on the comparables, based on the market when you finish your flip, when your rental goes to, get it appraised. So you're anticipating where the value is going to be. So your lender's going to lend you money, and part of that money is going to be based on what they calculate or you calculate the ARV to be. So we know what the ARV stands for, but let's just look at an example. Let's just say you found a property, and in this market, all fixed up, let's just say the ARV is $300,000. So that's the anticipated ARV of this property. The lender's saying, well, we're going to lend you, let's say, $210,000 because it's going to be based on what they calculate your ARV and what their loan to ARV is. So in this case, what we do is we divide the 210 by the 300,000. So let's put that in our calculator, and we're going to take the loan amount. The loan amount is 210,000, and we're going to divide that by 300,000. So this means your loan to ARV, when you're talking to lenders, the 210 divided by 300, we just put in the calculator, and we got it 70%. Your calculator probably showed 0.7, but in percentage points is 70%. Your lender's going to talk about loan to ARV, and how you calculate that is taking your anticipated value of the 300,000 and the loan amount that they're going to lend you, and divide the loan amount by your anticipated value. In this case, your loan to ARV is 70%, or on your calculator it just shows up at 0.7. So we went through point, how to calculate your interest, and loan to ARV. Next, we're going to go over loan to value, calculating your LTV and what that looks like. So now let's go over loan to value. You're gonna hear loan to value. You'll probably see a lot as LTV. The difference between loan to ARV and loan to value is the current value of the property with nothing else changed on it. So if you're buying a flip, what's the value now, today, and not what it's going to be fixed up to? Or when you go to refinance, when they do the appraisal, it's as of that day, so it's loan to current value. So easily, how do you calculate this? So we need to find the value. Typically, once again, this is going to come off of comps or an appraisal. If you're getting a loan, they will do an appraisal to calculate today's value as it sits. Let's just run through some numbers because this is probably the simplest of the calculations to use because it is what it is. Lenders are going to look at your value if they're not doing an appraisal. Current value is either what you're buying it for or what it's appraised for. So if you're buying a property, let's say you're buying it for $200,000. That's your purchase price. That's your current value. And your lender says, well, I'm going to lend you $140,000. They're going to do a loan for $140,000. So just like loan to ARV, we have the loan on this side, we have the value on this side. We're just going to divide the loan amount by the $200,000, in this case, the value. So let's put in our calculator. Let's take the $140,000 loan amount and divide it by the $200,000 value. And we're going to find out you're going to get 70%. Really on your calculator, like I said last time, you're going to get 0.7. But in percentages, that equals 70%. So when they're talking about loan to value, what they're talking about is the current value. The current value may be your appraised value, or it could be your purchase price. Lenders, especially traditional lenders and banks, always look at the current value as either the lower of your current appraised value or what you're purchasing it for. And that's where you get your value. They'll tell you how much they're going to lend you. To wrap it all up, if you're new to investing or even an old pro, you need to understand what a point is, how you calculate it, because it does impact your closing and it does impact your overall cost of doing business. You also need to understand how to calculate your monthly payment. They give you an interest rate. What does that mean monthly coming out of your pocket? Third, you need to know how to do loan to ARV. Most lending companies will say we lend up to 75% of the ARV. So you can take the ARV, the anticipated value, use their percentage and figure out their maximum loan. Same can be said on loan to value. You're refinancing a DSCR, anything like that. They'll give you a percentage. We're going to lend you 80%. We're going to lend you 75% of the value. You could then go calculate, if you're doing cash out, rate and term, what that loan would be. As an investor, these are things you're going to come across when you're working with lenders. If you have any other questions, if you have any other things that you would like me to run through and show you how they work or how to calculate them, just comment on this video or go to our website, thecashflowcompany.com, hit the contact us button, and we'd be glad to get back to you and show you how some of these items can be calculated and calculated easily.